The journey of the Nasdaq continues. Today it is May 10th. I am your host, the Cowboy. This is Elliott Wave Cafe and the charts of the day. Let's get started. All right, guys, so let's take a look. I'm going to start and take you to a little bit of a journey here, and I have some interesting slides for you. You're looking at the Nasdaq Composite, what you're seeing here in front of you, and there's about 3,700 stocks in this index. This one maybe started back in 1978. At least that's how far my data goes back, and I think it's pretty accurate. And the Nasdaq 100 only started to trade about 1985. So a little bit of a difference, but in the Nasdaq 100, obviously you have the top 100 mega stocks in there, excluding financials. And in the Nasdaq Composite, you have a lot more, so just about 3,700. Looking at the historical data in here, you can see you had a pretty big rise, let's say from 78 here to the dot-com bubble around 2000, an increase of about 4,500%. And then you had some retracements along the way. This is the crash from the bubble. You've dropped about 75% from the highs to the lows. Then you did a little bit of a rally again. And then here comes 2008, 2009 financial crisis when you drop about 52%, right? So, not that scary. Although I'm sure at the time you really felt that way because you came from 3,000 back to below 1,500. So you basically got cut in half. So these were major moves at the time. And then since the end of the financial crisis, you were able to rally about 1,000% to current highs or highs that were just kind of hit, at the end of 2021 or in the spring of 2021, I think, when we started to kind of top out. Sorry about that, guys. I'm going to have to mute this off. Doesn't happen that often, but and this is the little decline that's happening right now. In this decline here, it's about 24 to 25%. So officially, technically, we're supposed to be in a bear market, from what a definition on a percentage basis it is. So here we are. There's a little bit of a blip in here, right? We've dropped from 15,500, where it's about 11,700 at the moment. So we'll see, if we're going to be able to find the low, if this market will just kind of squeeze higher for a little while and then do another decline. But, if we're in some kind of a much larger correction, I think this little blip in here, it might not just be enough. Now, we can look at this as being maybe a fourth wave or a second wave in a still ongoing market, and I'll take a look at that in a second. But I just wanted you to have a little bit of a longer term perspective what's happening in the Nasdaq Composite. And these are obviously, it's a much, much larger market. Now, the trend model in here for the Qs, which are the ETF equivalent of the Nasdaq 100 index, it's trading at about 300 at the moment. And basically on the longer term, where it started to turn bearish, after the swing high here kind of happened, you're starting to turn back and you're fully on a bearish mode on a longer term basis. On a medium term basis in here, you are still on a bearish setup, and then as well on a shorter term basis, this refers to more on a weekly kind of time frame in here. It's still kind of negative, showing a little bit of a divergence in here between the lows in this indicator on the PPO and the price. So we might be near a little bit of a shorter term exhaustion in here, and we're going to look to see if we can recover. But I'm going to definitely pay attention to what's happening on a medium time frame here, where I'm basically looking at about a 5-week with a 13-week moving average. So this is definitely something that we're going to keep an eye on, since all the street terms are in a downtrend. Now, let's take a look at the counts and see if there's anything that we can read in here that can tell us, is there something that we can hang on? Is there a little bit of a rally? Is there a low close by? And, I'm going to start with, let's say, my best scenario, and I'm going to go, to bad and then to the worst, right? And then we'll see which one you like better. But, basically on a bullish setup in here, we're looking at this move from the lows to this highs as a wave 1. of an ongoing trend and bull market, with the three-wave decline happening in here for a possible second wave. Now we're looking at that as a wave A decline in here, so that's a clean impulse. I'm looking at this as a B wave flat in an A down to new lows in B, followed by a sharp rise in C. Flats are 3, 3, 5 in a B wave, back to the origin of this A wave in here for a C versus A, and then you decline again in an impulsive manner in this wave C of a wave 2. Now, you retraced at about 38% in here, and I think this is not a it's a retracement of the move, of the entire move from here, from this lows to this highs, without using a log scale, and we're close to about a 50% retracement. Now you can notice in here that you have about 100% equality, wave C versus wave A, right there. So that's a, I would say a positive sign, but I would not necessarily become, let's say, ultra bullish right at the moment. You need to see these prices started to kind of give you something to hang on. So a rally back above these levels would be something definitely that would start to look interesting. A rally back above 13K and this swing high in here in 5 waves will start to look even better. And then, if we're able to manage and establish a little bit of a low in here, then we can look to the next move, possibly to the upside. But this market has been, and in terms of sentiment, you'll see in a second here, has been pretty beat up, and especially this kind of latest low in here, it really started to kind of scare a lot of people off. And there's just not a lot of buyers, not a lot of interest just yet. The liquidity apparently is very small. Even in the option market, there is not a lot of interest. VIX is still very elevated, so there is a big cloud of fear that's hanging across this market, which usually comes when you're in such a heavy manner, when you're near a little bit of a swing point. Tomorrow we're going to get the CPI data. I talked about that yesterday as well, so that's going to be a little bit of an indicator to if the markets can relax a little bit. We'll see. That's coming at about 7:30 my time tomorrow morning, 8:30 Central. The next chart in here that's a little bit more, let's say, balanced, for a lack of a better word. You're looking at the decline here in 3 waves. Let's say that's an AB with some kind of a C wave diagonal in here for a wave W. You rally up an X with a prior B wave high. You're doing an impulse in A. Still going to get a rally in a wave B, followed by a C wave decline, and only then this wave 2 terminates after a little bit more proportion compared with the height of this wave 1 of these lows. So, this is, I think it's a fair assumption. You're right here at the bottom of these channels. You're supposed to start to pick up some momentum from here and return higher. So it's a very good, kind of justifiable point and level for a rally, right? Combined with some support levels that we're having back up in here. So we'll see if the market responds and gives us at least some kind of a rally here, maybe back towards 13.5, right? Maybe an 800, 900 point rally in the Nasdaq 100. But we're going to have to, there's a lot of wood to chop. You're going to have to get to this trend line. You're going to have to get back above this X wave, and then the market can possibly relax and continue to push higher. But before that happens, there's going to be a lot of narrative that are going to flood the market, right? At the moment you're kind of starting to push back in those levels. So the market, the price will start to react first, and then the narratives will follow in the financial media. The next chart that I'm looking at in here is basically, the more bearish scenario. And this is, the kind of the worst scenario that it could happen, where you're looking at this as a wave 1 with a flat in wave 2. So instead of an AB, this is just a 1-2. Instead of this being a C wave, this is actually a wave 1, because both are impulses, motive waves. And, but the tricky part is that this requires a second wave. So you can see all 3 scenarios are looking for a rally shorter term to give you some kind of a correction, right? Either as a wave 2, either as a wave B, either as a wave, X or whatever we had in the other one, just to kind of, start to balance out the move lower. So in case we're going to get a rally in a second wave, usually those travel 50 to 61.8%. So that's still something that can push us back towards, let's say, 13.6. The problem with this scenario is that, this is a 5th wave, which means there is a much larger top in the market, and this thing could continue to decline for the rest of not only 2022, but maybe even in 2023 as a much larger bear market. It's tough to believe that that's where we could be going. I don't know what has to happen to these stocks and to this economy for such a thing to happen. So, you kind of have to run your imagination wild in here, and I'll let you have at it. But I think it's not a very likely scenario. So, but you never know. So this is kind of where what could unfold as part of a much larger bearish decline. But I do like the fact that this so far looks like a three-wave setback, and we have to kind of treat it as such. So, the next one that I'm going to show you in here, it's a little bit scary as well, but it's coming into some extreme levels. And this is basically, the line back here in green shows you the new, the new 52-week highs in the NASDAQ, in the NDX, right, in the NASDAQ 100. And, it was just about an issue today that made a new 52-week high. You had 31 of them that actually made new 52-week lows. So it's pretty heavy, pretty extreme. I mean, you look back at 2019, 2020, 2015. I talked about this, for the S&P 500 yesterday as well. So we're coming into some, zones in here where a sharp reversal, it's very possible. These levels of negativity and decline, and straight on down selling with 52-week lows, it's very hard to sustain. The markets, don't necessarily like that a lot. The markets sell lower much quicker than they go higher. So usually you're getting these flushes to the downside. That's why, you're getting much more green pastures in here than you get red. So usually these kind of red scenarios, are short-lived. And that's why you're getting more of an elevator down type of a market sometimes. And I'm just going to take a quick pause here for a few seconds, guys. If you want to get in touch with me, you can find me on Telegram, Elliott Wave Cafe. It's where I'm at out there. This is the public channel. There's a public chat if you want to chat with me there publicly. And then there's a premium room you all know about. It's the link for this is below if you want to try my services. If you want to be part of my team, come in here, check us out. And then on Twitter, I'm on Elliott Cafe. You can find me in there as well. So just a quick pause. All right, moving on. I'm looking at the Qs one more time, and this is another, breadth indicator in here that, it just kind of shows you what this one did, but it's a little bit on a different scale. So you can kind of see this, new 52-week lows. And basically you have pretty much a zero line in here, and it just refers to, and here you are at about 30 issues that are kind of doing this. Back in COVID low in there, you were at about 50. But I mean, these levels are they can happen very quick, and then the market just kind of continues. So just another quick look at a visual of what's going on a new 52-week low list in here. I think I've doubled this up as well by mistake. No, actually what this says, it's I thought it's a double chart, but it's not. When this one shows you, it shows you the percentage of the stocks that are at about a 12-week low. So you're looking at about, what is this, about 3 months of price action, and how many of them are at the 12-week lows. And this breadth indicator is starting to diverge. So you can notice that in the first sell-off that we've got in the NASDAQ, you went as high as 60%. They were making 12-week lows. Then on the subsequent one low, you were only at about, 50 or 55 or something like that. On this new low, you're only at about 40. So the lower we go, underneath the surface, less and less stocks are making 12-week lows. And this is kind of how you start. You start with the 10-week, 10, let's say, 10-day moving average, then 20-day moving average, and you're moving up to the 50, to the 200. And the breadth starts to improve by those stocks that were beat down the worst, that they're not making new 12-week lows, and they're stabilizing and they're starting to improve. And that's how a market turns from being bearish to being stable to being bullish. So you got to look underneath the hood, underneath the surface, to see what's going on. And then here is, you know, the next chart in here, the basic, you're familiar with this. I think I've showed it in the last presentation as well, but you're looking at the breadth indicator. These are percentage below the 200-week moving average and below the 50, again, into some, you know, quite extreme levels. The one that's below the 200, it's at 15%, which means 85% of them are below the 200-day. You know, these lows haven't been seen since the COVID low in there. So we're coming quite extreme. Also on the ones at the 15 here, you can see you're at about 10%, which means 90% are below the 50-day moving average, coming into some big, strong support. And I think we're close, guys. I think we're very close. Here is what's going on in the VIX. It's last time we talked, it was just kind of below this purple horizontal level. Now we kind of broke back above that level, coming into some, you know, extreme over fear, if I can call that, territory in here towards 45 in the VIX of the NASDAQ. And again, these are some levels that are rarely sustained unless you're getting a big flush to the upside, you're getting extreme fear. Let's say another, I don't know, 500-600 point drop in here. You're going from 12.5 to, I don't know, maybe even 1,000 from, you know, to 11 or to 10.5 or some kind of a crazy move in the course of 2-3 days. And that creates a big spike into the, you know, the volatility of the NASDAQ, and then you're done. That's called a capitulation. But we're definitely, you know, right there where if this happens, you know, we're very close to a move in the opposite direction. Just a quick look at, you know, at the sectors. I wanted to remind you of these. So these are the sectors that compose the S&P 500, even though I talk about NASDAQ. The communication sector continues to improve on the weekly basis. You know, here is the consumer discretionary starting to improve as well. So from lagging, pushing higher. The technology sector looks, you know, much better. So these stocks, you know, underneath the surface, they're starting to work towards more of a positive momentum. They're declining at a lower rate. And that's something definitely to keep an eye on. And all the defensive sectors like energy, look, utilities, healthcare, they're starting to kind of curl lower. They're still leading and outperforming the S&P 500, but they're doing so at a lower rate. So this is something that, you know, these are the sectors where I'm looking to shop and just kind of see if there's anything interesting there that can generate some good returns towards the rest of the year, maybe into the next year. You know, just in the close over here, guys, don't forget, visit me on ElliotWaveCafeSubstack.com for my newsletter in here. This is the latest article, Markets Used to Be More Fun. I don't think you're going to get depressed reading it. You might get a kick out of it. So go ahead and check that out. Subscribe. It's free. You're going to get it in your email, and I'll be writing more on there. And then once again, here is where you can find me. I'm just going to close off. I'm going to tell everybody goodbye. See you for the next video tomorrow. Thanks for watching. Don't forget to subscribe and like. And I'll see you soon. Thanks for being here. Bye-bye.